I'm going to try to spend a couple of minutes sharing with you some perspectives on building companies of value in a short-term world. In order to do that, where are we? We're not at the beginning. We need to go backwards. Thank you. So here's where we start, okay? So we're going to start by talking about building companies of value in a short-term world. What do we mean by that? Right? What are we talking about today? We're talking about how do you do this? How do you do this for the long term over multiple decades? To begin that discussion, I'd like to start by telling you a little bit about myself. I've been the CEO of a public restaurant company for 26 years. Think about it. I've been running a public restaurant company for longer than Cal Ripken was playing baseball. Right? That's a long time. Let me tell you something about the company I led along the way, the company I built. Panera today, nearly 2,400 units, 120,000 team members, $6 billion in system sales, 11 million meals a week. I like to say we serve 1 out of every 30 people every week, 1 out of every 30 Americans every week, 21 fresh dough facilities, 2 million square feet of manufacturing, 400 over-the-road trucks, and a $7.5 billion market cap when we ultimately sold that. Okay. Over the past 20 years, as John referred, Panera has delivered the best stock performance in the food industry, annualized returns of over 25%. Think of it this way. We delivered twice the performance of Starbucks, 4 times the performance of Chipotle, and 44 times the performance of the S&P 500. In fact, as somebody was telling me just 2 months ago, I hadn't realized it, over these past 2 decades, our performance beat Warren Buffett's performance at Berkshire Hathaway. So how did that happen? Wow, thank you. I'm blown away. Right? You'll find out about your own businesses. You never realize how impactful what you're doing is till you get to the other side. Okay? So what enabled Panera to succeed? How do we get here? This is the question today, and then I want to talk about the implications for you. Fundamentally, it comes from a commitment to executing long-term transformation and truly delivering for our stakeholders, our guests, our associates, the communities in which we live, which enabled Panera to ultimately build competitive advantage. That is to say, people wanted to walk past our competitors to come to us and ultimately deliver those better returns. It was the long-term transformations that over the 36 years that I ran this company that were at the core of it. Every 5 to 6 years, we faced another transformation. What was good enough yesterday is not going to be good enough tomorrow. And our job as leaders is to discover today what is going to matter tomorrow. So think about it. Let's follow Panera through its 4 or 5 key transformations. When this started, it was a single little cookie store. That was my first store, 400 square feet in Boston. It started as a single bakery. And the first transformation was the understanding that the bread and croissant could be a platform to sell soup, salad, and sandwiches. And a broken down little company very quickly became a category everybody wanted to compete in. By '91, we went public, all on the backs of being a bakery cafe, not a bakery. Transformation number 1. Transformation number 2 was a powerful understanding of our customers and the niche that they represented. Simply put, by 1993, it was very clear to us that there was 1 out of every 3 consumers were rejecting fast food. Fast food had become mass-produced, commodified food that people didn't want. And people held their noses when they went in there. Self-service gasoline stations for the human body. And ultimately, what we began to see is this consumer who wanted to feel better about the food they ate. They wanted real food, environments that engaged them, people that actually gave a hoot, and they ultimately wanted self-respect in the process. And that understanding is how we built Panera, from that kind of vision. And that understanding ultimately became what is now called fast casual. We did it, Howard Schultz at Starbucks, Steve Ells later. It's now a $50 billion category. But back then, when I was talking about it, nobody wanted to believe in it, because nothing is proven until it's done. Transformation number 3, 1998. Panera is one of 4 divisions of a public company. Au Bon Pain, Au Bon Pain Manufacturing, Au Bon Pain International, and Panera, all under the name Au Bon Pain Co. Inc. I'm looking at Panera, and I'm saying this has the potential to be nationally dominant. How are we going to get there? 1 out of every 1,000 companies ever make it. You all know better than anybody. It's the most difficult thing in the world. And I could see it and I could feel it, and I knew this was the gem. And how are we going to care about it? How are we going to take care of it? And I was away over Christmas. I was with a friend, and I was lamenting. I was kind of down. And she looked at me and said, Ron, what would you do if Panera owned those other Au Bon Pain divisions, not Au Bon Pain owned Panera? If you thought about it differently, what would you do? And I looked at her and said, if I had any strength, I would take all the other resources we had and monetize them. I would take myself and the very best people, I'd go down there and make it happen. That's a revolutionary thought from a different paradigm. And I'm the kind of guy, like many of you, if I say I'm going to do it, I go do it. And that idea marinated with me for a couple of months, and I came back and said, let's go do it. Now, this was profoundly difficult. The next year and a half of my life sucked, all right? Everybody was upset at me. My board wanted my job. Why was I taking Au Bon Pain and selling it? That was the company they invested in. My team members were fighting with each other, who was going to stay and who was going to go. And every day I had uncertainty. That's what transformation is about. Today it looks brilliant. The stock is up 100-fold. But when you're going through it, it doesn't feel brilliant. It's painful. Transformation number 4 occurred in the late zeros. Panera was beginning to slow down. Its growth curve was slowing down. I could feel it. Its comps were slowing down, and I was unsure how we took it from $5 billion to $10 billion. And over a weekend, I was out doing some acquisition work. I came back and I wrote a vision. It's a great process. I sat down and wrote a vision of how I would screw with Panera, how I would compete with Panera if I weren't Panera. That's what you want to be doing. Looking at your business from outside, because your job as a CEO is to bring the outside in. And how would I compete with it? And ultimately, what we constructed as how we would compete with Panera became the transformation plan that began around 2010. It was about being a better competitive alternative. It was about runways for growth, how we took ourselves from 5 to 10 billion. It was about building capabilities, HR and IT. And it was about making sure we had the resources to invest as we went through it. And each of those had big implications. You had means. Means were about clean. Means were about wellness. Means were about digital before people were talking about it. But we understood it. Growing from 5 to 10 billion was about entering a whole bunch of ancillary businesses. I got an 18-year-old son, and I often find him banging his head against the wall. And I say, Michael, walk 3 feet to the left or right. There may be a door there. Same thing applies to all of us. Just look. There were ancillary businesses that were billion-dollar pluses from the Panera platform. Capabilities, you better face your reality. Without capabilities, you can't get there. And then ultimately, you got to pay for it as you go. You got to have the resources. The result, that plan worked. In fact, the key themes of our strategic plan, for any of you in the restaurant industry today, no, they have become the keys to success in this industry. Wellness, Panera is the #1 wellness brand in the United States today of any scale. Clean, we are the first folks to remove any artificial colors, flavors, preservatives, and sweeteners. Digital, Panera is pushing 36% digital. It's the highest digital rate of any restaurant company in America outside the big 3 pizza guys. Loyalty, the largest loyalty program in the food industry, tens of millions of people, over 50% of the transactions in loyalty. And omnichannel, we led the charge with catering. We led the charge with delivery. It's been an important part of our business over the last 3 to 4 years. All of these themes need to be built over time. And the question I ask you is how you give yourself the time. The result, Panera's comp store sales growth led the industry in 2017. We were up 600 basis points in 2017. Relative to our industry, that's 800 basis points better. The byproduct of that, Panera's earnings, Panera's stock, and Panera's credibility hit all-time highs in 2017. So I want to step back for a second. All right, we're going to talk about where we went with Panera in just a minute. But I want to broaden it and talk about the public markets. And I want to talk about its implications for you as private companies. The reality is, I've had a powerful vantage point over the last 26 years to observe the evolution occurring in our public markets. Let's understand that because it informs the world in which you live. What have I seen? Here's what I've seen. Our public markets have become increasingly short-sighted and indeed hostile to those companies like Panera, competing on the basis of long-term transformation and competing on a basis of stakeholders, not just shareholders. It's a very important point. Today, in today's environment, Panera could not complete the transformations that led to this powerful value creation. It's the reality of the public markets today. You got to understand the world that we're living in. Let me share with you the why of it. Investors increasingly rent stock. They don't own shares in a company anymore. What do I mean by that? You go back to 1960, the average shareholder held for 8 years. By 2016, the average shareholder was holding a stock for 8 months. Think about the implications of that and how they think and what that does and how that affects anybody who's operating in a public market. And if you're in a private market for capital, how that affects the people that are coming to you with capital. The reasons, it's very simple. Hedge funds are increasingly trading stock on an assessment of the next data point. I can't tell you how many times a hedge fund would come to me and say, I love your story of transformation, Ron, the big picture in the long term, but what were your comps last week and what are they going to be next week? That's the question. They're not trading on the long term. And the assumption is, why buy the stock if you don't need to? Transformation is coming later. I can buy it then. There's a lot of liquidity. What else? Active money managers are now focused on short-term performance. Why? Because they're being marked to market on a quarterly basis, and they're heavily incented on those quarterly results. So again, if the results aren't there, why buy? What does that do? It makes transformation that much harder. And there's something else, the increasing use of high-frequency algorithm-based trading strategies. It's called flash trading. It magnifies the problem. You may not know it, but 60% of the public stock markets, 60% are trading in microseconds based on algorithms. It's just quant. It's magnifying the problem. What else? The ascent of passive index funds. They further intensify a focus on short-term performance. They're not trading the stock. They're not moving in and out. They're holding the index fund. So what does that mean? Corporate governance is less important to them. Ultimately, a lot of that corporate governance has historically been outsourced to ISS, Glass Lewis, and the public governance companies. There's nobody making those judgments about long-termism. And here's the nut of it all. This is an article from the Harvard Business Review about what's happened at the heart of corporate leadership. It talks about something called agency theory. Agency theory emerged in the 1970s. And it argues that management is singularly an agent of shareholders, not stockholders. I'm old enough to remember the days when you ran a company, you were concerned about all your stakeholders, and when you delivered for them, the shareholders got informed. The world of agency theory is you are simply an employee in a public company of the owner, which is the shareholder, and they have the right to expect you to do their bidding in a short-term sense. And what this means is it rationalizes one stakeholder, the shareholder, to the preeminence of all other stakeholders. And it also rationalizes short-term behavior. It doesn't take me any more effort than it takes you and your companies. If I want to boost the profit short-term, I can make cuts and get it done. I may be selling off the future and the dream and what could really create value, but that's what it is. And that's what agency theory is about. And it's become the prevalent mantra in corporate America. And it's not right. It's wrong. It's not legally derived. Our shareholders are not owners in the sense that many of you are. Their name isn't on the door. They don't have liability. They don't carry responsibility. And they don't have a long-term perspective. Here's something else, the byproduct of all this. And get clear, it's the reality. More activist investors with a short-term focus and financial engineering playbooks are out there. Since 2012, 18% annual increase in the number of activist campaigns against public companies, 18% a year. Last year, in 2017, the number of activist campaigns doubled. Think about that. Understand its implications. Understand what this means. In my industry, the restaurant industry, 20% of the restaurant companies were attacked last year. Fully 20% of them, Buffalo Wild Wings. It didn't help. Right? It's happened to every major company. Last week, Bill Ackman, one of the renowned activists, bought stock in Starbucks. Here's the point I'm trying to make. Do we really think we're better served by having some 35-year-old kid sitting in an office in Manhattan, looking at a screen, making decisions about our companies? Is that the way we really want to run this thing? Are all these they're bad management teams, but are all of them so bad that we need to do it? Truth of the matter is, a lot of these kids I wouldn't hire. And yet they're, because of the way the system is set up, they have the leverage. Look at Eddie Lambert and what happened with Sears this week. It's a reality of it. Good guy, brilliant investor, terrible retailer. And he drove Sears right down into the hopper. And it can happen over and over and over if we don't realize what's going on. And let me tell you something. It's not just the little companies. It's increasingly the larger companies. All of these companies were attacked by activists in the last year. Are they all so mismanaged we need somebody coming in from outside to straighten them out? Is it that bad? Fire the management team. But don't continue this process of bringing in activists to do it because the system has created that. So here's my point, and I want you to get it because it affects you as a private company. How does activism affect our boardrooms and our CEOs? What happens in this process? It's psychological. The reality is this: fear hangs over the decision-making process in most public companies. It hangs over what goes on in your boardrooms, and it hangs over management as they seek to become an activist, to avoid becoming an activist target. Do you know what the mantra in corporate America is for guys like me? Be your own activist before they do it to you. Right? There's a sense of powerful pressure that subtly evolves in boardrooms. Boardrooms are weak. They're not strong. And activists have power, and they have the bully pulpit. And what do you think ends up emerging? What ends up happening is the very opportunities that created Panera and the value creation, they're not even considered. Why? Because nobody in a boardroom wants to take on that risk of going through 3, 4, and 5 years of transformation. That's what ends up happening. And what does it do to our CEOs? Let me tell you something as a CEO, and I think you understand it. The sense of vulnerability, the sense of risk for a CEO is powerful. What our CEOs do is they do what they're asked to do. They avoid, in a public company, taking on those risks because they want to keep their jobs. They want to stay in business. They want to be able to maintain. So they avoid the very things that create that better competitive alternative. Here's something else to think about. The irony of this whole thing is what companies are winning? The FANGs, Facebook, Amazon, Netflix, and Google. What do they have as an advantage? Capital structures that let them make long-term decisions. Often dual-class stock. They control. They can make the long-term decisions. They're winning. That's the irony. I was talking to one of the largest money managers in the world, runs $1 trillion several months ago. They're telling me 90% of their alpha, the stock appreciation, is occurring through long-term transformation. And yet the market is giving a competitive advantage to those that have investment structures that let them make long-term investments at the ill effect of what's happening to every other public company. This is competitive advantage, folks. And the reality is the nature of today's capital markets and the corresponding increase in investment activism, simply put, dramatically inhibits the old-fashioned value creation executed as we did at Panera. That's the reality. You can't do it the way we did it in a public company anymore. So how did I, as a successful public company CEO who saw this and got it, choose to deal with this understanding at Panera? Let me tell you something. You heard the success story. Could it be any better? The truth is, though, I had activists twice. In 2008, Shamrock Holdings, Roy Disney's group, attacked us, told me I should listen to one of their vice presidents. He could give me better direction on how to run the company than we could, which meant raise prices. 2015, Luxor Capital attacked us. We were in the middle of this powerful transformation investing in technology that everybody thinks is so phenomenal today. Back then, why don't you just cut some of that cost? Why not? Can't hurt. Why not? That's what happened. Now, the truth is, I won. I won because I had the credibility. I won because I voted 17% of the company. I won against the activists. But the truth is, how does that happen if I'm not there in a public company? How does Panera continue to be able to do it? And it woke me up in the middle of the night intensely. Here's the reality. As a public company CEO and somebody who loves his company every bit as much as you love yours, I recognized how tentative it was. At 4 in the morning, I would wake up, not worried about the transformation plan, not worried about what we were doing, but worried, could these guys take it away from me? Worried that I couldn't protect the vision, that I couldn't protect the people that worked there, the people that I cared about. Because the truth is, and you know it, you may have the right idea, but nobody knows what week it's going to turn. And the reality is, things of value take time to build. They don't get built overnight. And it isn't about the short-term impact. It's about making the long-term bets and then being right about them. And the reality is, it doesn't take much for these activists to come in, say, I own 1% of your company, I got another 7% in options. You now work for me under agency theory. I want you to cut your G&A by a third. I want you to cut R&D in half. I want you to dividend out the money. And what the hell, let somebody else worry about the carcass in 2 years. That doesn't take a lot of work. But imagine that sense, that feeling that occurs to you as a CEO when you're going through that. That's what I felt. The result, I chose to take Panera private last year with an evergreen investor. $80 billion fund from Europe, $80 billion that had no terminal point, $80 billion, some of their business had been held for over 100 years. These were long-term thinking people I knew. And this was the kind of home I wanted for my company. Because I knew if we were going to create value creation, this is where we wanted to be. So why did I do it? It's really simple. I wanted to protect our competitive advantage, the ability to continue to innovate and make long-term transformative bets. That's what got us there. Why else did I do it? To insulate our stakeholders, who I felt a responsibility to, from the predatory behavior of these short-term financial engineering activists. And then third, I did it to ensure Panera could remain a conscious company, thoughtful, and in the hands of long-term investors for the long term. So I could make sure that my team members were equified. So I could make sure my franchise company ratio stayed stable and wasn't just a path to short-term financial engineering. So I could maintain our shareholders and building value the long-term way. So here's my question to you, where I want to spend a minute. How should you be thinking about corporate finance? How should you be thinking about it in private companies? And how should you be thinking about your company in the future, in the face of an increasingly short-term focused market? All these forces in the public market are applying in the private markets every bit as much. And we're going to talk about that in a second. You've got to start by recognizing this. Even in a private company, how you choose to finance your growth dramatically affects your ability to drive competitive advantage, which is everything in business, and ultimately build your business over the long term. You need to know that. It's fundamental. Financing is not simply a step on the corporate life cycle. It's not a treadmill you want to get on. Here's a couple of suggestions to think about. Start by recognizing financing is about choosing a partner for life. Indeed, how you finance is anything but another milestone on that corporate life cycle. I'm always surprised by the number of people that are out there financing every 6 months, every year. And they think that's what their job is. They're wrong. The reality is, who you choose for a financial partner, the best metaphor I can think of, it's like who you have a child with. Once you have that child, you are bound for life together. And the reality is, they are truly your partner. They can influence you and impact you. And similarly, in your private companies, who you finance with, you are bound with for the life of that company. And you better be very clear who you're doing business with and what you're doing. Let me talk about something else. Maximizing your company's valuation in a financing, particularly when there's preferred instruments. Do you know what that is? Preferred instrument or anti-dilutive clauses likely will not serve you well. There isn't a week that goes by I don't have somebody that comes to me and says, I got in trouble with my financing. Typically, the way it works is you go out saying, hey, if I get a higher valuation, that's great. But that valuation becomes a high watermark that's essentially hung around your neck. And that high watermark is, depending on how your instruments work, and almost undoubtedly you'll have preferred stock going to your investors, they've got to get their money back before you get any of yours. And many agreements have what are called anti-dilution clauses, which means if the next round of financing occurs at a lower value, everybody who's bought stock earlier gets it at that value. That means you explode the dilution that occurs to you individually. I'm going to tell you, at least once a week, I have somebody at my door who didn't understand this and are looking at the fact that they've run out of cash, they've had a bump in the road, they want more money, and yet they have anti-dilutive clauses. If they raise that money, they're going to go from 10 or 15 or 20% equity down to 1% and get washed away. That's what happens all the time. And let me share with you something else. Don't forget what control really means. I was thinking about this the other day in terms of my own life. Control is really simple. When we talk about who's in control, control means if we have a pissing match, you go and I stay. It's that simple, right? Do you want to maintain control? For the price of the Inc. 5000 Gala, I'm going to give you some advice. The best thing I ever did at Panera 30 years ago was do dual class stock. Dual class stock, 2 different voting levels. The stupidest thing I ever did was do dual class voting stock with 3-to-1, not 10-to-1 voting. What that meant is if I had done it 10-to-1, I would have controlled the vote forever. The fact that I did it 3-to-1 meant I only voted 17%. There are ways to protect yourself, but you want to avoid that and protect that and put that in place early. Here's another thing. If you can't retain control, the right partner is fundamental. First and foremost, understand how your equity partners are planning to profit and what they'll focus on as your partner. Don't listen to the words. It's what you tell your kids when they're dating, right? Look at the actions. Look at what they do. Look at how they've dealt with other companies. How long have they stayed in them? How have they thought? Call other places where they've invested. Find out what they brought to the board. Are they financial engineers? Are they folks that have really, their backgrounds are around financial engineering? Or have they ever run a business? Do they understand the implications of what you're dealing with? Do you understand what you're doing? And I'll share with you something else. The private equity market, which has now become very significant, has become every bit as challenging as the public markets. This has become a business. They're raising money. What's their business? Essentially raising their next fund. So what happens in private equity often? If you're really a great company and you deliver a great potential and a return, they're going to sell you quick. They're going to sell you in 3 or 4 years. Why? Because they want to mark that up. They want to show that return, get that IRR in their portfolio as they raise their next fund. And if you're a dog and you don't deliver, you may hang in there 8 or 9 years. The truth is, the really good companies go fast, get sold. The really bad companies get stuck. And the reality is you want to understand how private equity is earning its keep. And you want to understand who your private equity is and what their time frame is. And then lastly, you want to find partners that share your values and your perspectives. It's just like marriage. Don't enter into this unless you are really clear who they are, because you're bound for life. And that's the most important thing I can say to you as a private company seeking financing. So here's what I did. After we sold Panera and reinvested in it and I created my own investment fund. I decided I want to put my money where my mouth is. I and a couple of partners, people have been with me at Panera. And I created the investment fund I would have liked to have worked with along the way. 3 principles within Act 3. That's what we're calling it. Obviously, Obon Pen Act 1, Panera Act 2, and Act 3 principles. First is founder-friendly capital. The second is venture support, not venture capital. And the third is investing where we have some knowledge and competitive advantage. Simply put, founder-friendly capital, it's a $300 million fund. It's evergreen. We'd be quite happy if we never sold it. We never sold a single investment. We'd be much more happy having the cash at work and continuing to support great companies. It's entirely funded by us. No LPs, nobody else who needs a return. We're not raising another fund. Secondly, we have what we call reliable capital or stable capital. Typically what happens is you have different investors at every seed round, seed A, B, C, D, and E. We're saying we'll take all the rounds. If we're investing with you, we want to be with you. We'll give you that capital so you don't have to go out and raise more money at a predetermined multiple. It won't be the highest valuation, but it'll be a stable valuation. And fortunately, you won't have to be spending your time raising money. You just have to call the bank, and you know that that money is there. No more fundraising, no more preferred terms, no more anti-dilution clauses. The second piece of it is venture support, not venture capital. For us, we're experienced in concept evolution, growth and business building. We don't do finance. We build businesses. And so our approach is what we call Sherpa management. What do I mean by that? I tell you this. Very few people ever make it up Mount Everest. Almost nobody does. I can tell you nobody's ever made it without a guide. The number of ways you can fall off, the number of mistakes you can make are extraordinary. To me, that's what building a nationally dominant company is about. And our view is we want to be there to provide the information about the mistakes and avoid those mistakes before they happen. That's what we call Sherpa management. Third, we're focused on helping management teams build better competitive alternatives. Our focus is not financial engineering and what the next financing is and what the terminal point is. Our focus is on focusing on building that better competitive alternative and getting your customers to help to walk across the street. Finally, we're offering shared services. If we're in this for the long term, why should you be rebuilding technology? Why should you be worrying about all the infrastructure of concept thinking and strategy and research, accounting and HRIS? We're taking that and centralizing that and allowing our entrepreneurs to stay focused. And we got some great businesses. Some of you may know we just helped Cava take private a public company called Zoe's. It's going to build the dominant Mediterranean chain. We got a great operation called Tate in Boston. It's an upscale bakery cafe. We're doing wellness. We've got a concept called Life Alive that's powerful, and we're doing some stuff in entertainment. And the last piece of it, and this speaks to it, we don't want to invest anywhere where we don't know something. You know, I'll tell you something, right? I go to a lot of these events that are in casinos. I never walk in the casino. I don't like losing money. And over time, you lose money in a casino. What I want to be is the casino and have you whales walk into my casino. That's where you make money. That's how I view investing in a business I know. Investing in consumer-facing restaurant concepts. Because we know something, and that's competitive advantage. And without competitive advantage, you're going to die. Okay, so I want to wrap this up in 5 or 6 minutes with this. So far, we've talked about financing your business. But I believe the pervasive short-termism found in our capital markets is not only bad for our businesses, but it's also bad for our economy and our country. These are much bigger issues that affects us in every sense of the word. As a society, I truly believe we've got to recognize the ways our markets are increasingly misserving our collective needs. It truly is it, and you know it, you feel it. Right? Top business leaders are concerned. These are the leaders of American business, Warren Buffett and Jamie Dimon. They said the financial markets have become too focused on the short term. Companies frequently hold back on technology spending, hiring, and research and development to meet quarterly earnings forecasts. Can that be good for the society? Pundits are telling us public markets are falling apart. Andrew Ross Sorkin wrote within the last year in the New York Times, "It's no secret the public stock markets, despite the heights they reached, are fundamentally broken. No chief executive wants to live in the glare of a public spotlight, other than idiots like me, and deal with pesky investors who hold stock in time frames of days and months, not years and decades." Here's the reality. The number of public companies has shrunk by half in the past 2 decades. There's a reason less companies went public last year than went public in the height of the recession. The public markets are dangerous places for people that want to build businesses. And here's something else. Leading academics are arguing there are serious public policy consequences if we don't fix our markets. This is a friend of mine from Boston, Clayton Christensen, Clay. He's the guy behind innovation, Innovator's Dilemma, Innovator's Solution. He says, look it, in the market in which we live, the environment in which we live, he calls it the church of new finance. In this world, the only kind of investments companies are able to make are short-term investments. What are they? Cost cutting. That's it. And the problem is that those investments deliver the short-term results, but they take off the table the very kind of innovation that drives productivity improvements, the very kind of innovation that drives real growth. Here's my point. I just said it. The short-term focus of today's public market poses a powerful challenge of the ability of American companies to innovate, compete, and generate that real growth. Folks, get it clear. Innovation is at the core of your productivity improvements. It's what you do with your businesses every day. It's putting off the short-term return for the medium and long term. It's why you work so hard, betting on the long term. It's the same for the society. If everybody's focused on self-pleasure and the short term, what happens? And let me tell you something else. Right? If we don't get that kind of innovation in our economy, we end up without GDP growth. And I don't know your politics, but I'm going to tell you, a tax cut is simply a sugar high in the short term. Nobody has ever shown a way to grow GDP growth without productivity improvements and innovation. It's that simple. And our system is completely set up in opposition. This is what Larry Fink of BlackRock said. The time's come for a new model of shareholder engagement. If engagement's to be meaningful and productive, we collectively are going to need to focus on benefiting shareholders instead of wasting time and money in these proxy fights. Engagement needs to be a year-long conversation about improving long-term value. And here's another guy who had something to say about it, Donald Trump. And between you and me, there's not much I agree with him on, but this I do. He said, we're not thinking far enough out. We've been accused of that for a long time. So we're looking at dropping quarterly guidance very, very seriously. We're looking at twice-a-year guidance instead of 4 times a year. Now let's just hope they stick with it. Right? And here's my point. Structural changes are being proposed, and we've got to figure out whether we're going to get behind them. What are some of those structural changes that begins to fix this problem? It's a market in which there are differential voting rights based on your holding period. Differential voting rights. In Europe, there are countries that have differential voting rights. Do you not think that as somebody who owns a stock for years, decades, you deserve more of a vote than somebody who's owned it for about 20 seconds? That's what we're talking about. We want long-term thinking. This doesn't help our society. And what else? A moratorium on guidance. I can tell you as a public company CEO, the name of the game was meeting the analyst guidance. So we managed them. That was where it became not managing the company. And let the guidance be, let the results be what they are and get out of this game of managing the guidance. And then lastly, we've got to affect the compensation programs. It's got to be based on long-term performance, not just stock price. In an up market, people made a lot of money, but long-term performance at the core of what matters, building better companies. Okay, so I want to wrap it up, but here's the point I want to leave you with this afternoon. Here's what I want you to be thinking about. As business people, as business builders, and as citizens, we must understand the consequences of how we finance in our individual businesses, and we must understand the ultimate effect our pervasive short-termism and exclusive focus on shareholder value creation has on our companies and our nation's competitive position and economic growth. Folks, if we don't, the long-term health of our companies, the long-term health of our markets, and ultimately the vitality of our economy are at risk. Thank you.